Welcome to the daily update, where I'll go over the action in the market for Thursday, August 8th, and then we'll see how things look for Friday, August 9th. Had a pretty solid up day. Of course, the few little posts that I saw on Twitter, biggest up day since 1916 or something. You know that I'm not a real fan of comparing what's happening now to a previous time, but it was a pretty solid up day. Now, the thing that we have to look at is, are we starting to see a nice little bounce from here? Or are we just bouncing to work off some of the oversold condition that we've been in before we resume going down? You can make a case for either side at this point, but when we look at all of our charts, we're still negative in the short and intermediate term, but our list of extreme negative indicators has really shortened up quite a bit. So right now we kind of have to default to thinking that maybe there's still more downside that's possible. So anything can always happen. We just have to look at the charts and say, okay, this is where we stand as of right now. I do have a thing called the SPXInvesting Program, welcoming new members right now. I might be shutting down the enrollment at some point because I want to keep it more manageable, but please feel free to check that out. There is a list of links below this description in the video that'll take you either to the website or to some videos that talk more about the program. And the daily video that I do is the real foundation of all the different videos that I post throughout the week. Over the weekend is when I prepare the outside videos, but every day, naturally, is the day that I do the daily video. All right, let's go back and talk about what happened. We had a higher open, and we were actually down a bit. When I recorded the video for yesterday, the futures were down about 0.25%. Well, they liked the reaction to the initial and continuing jobless claims. That seemed to satisfy the market. One thing also to keep in mind is if we are in the midst of a downtrend, which in the bigger context, we still are, some of the biggest updates you're ever going to see are when we're in the context of a bigger downtrend. Just like when we're really going up, some of the biggest down moves you'll see are in the context of the uptrend. Just something to keep in mind before everybody just automatically assumes the market's going to go up from here. Anyway, we did have a higher open and prices got above R1 at 52.88 before chopping sideways and then getting to that 5,300 level. There was a battle going back and forth there. These round numbers can often produce some tug of war going back and forth. We didn't see a real decline from this. One thing that I was watching for when we had the gap higher open in the context of a negative trend is that we gap up and then eventually fill that gap, like what happened on Wednesday, but then we just kept going to the downside. I kept waiting to see, were we going to see something like that on Thursday? Didn't really materialize. The S&P was able to hold on to its gains right around the R1 level, and we finally got above the 5,300 level, and we closed pretty much at the intraday high, just a little bit below that. We were up 2.3% on, this is a warning sign, below average volume. We've been seeing above average volume lately, even though it's the summer months, and typically it does really trail off in July and August, but we've been above average as the market's really been reacting to things. However, we dropped to below average in Thursday's session on an up day. That is a warning sign. All right, so we are still negative in the short and intermediate term, working off some of that oversold condition. We're still positive in the long term as the market works through this inflation, interest rate, growth. Are we going to go into a recession? Are we not? All of these different scenarios, plus all of the different geopolitical things that are happening right now. There's still unrest going on in England. There's things that could escalate in the Middle East. And then there's the Russia-Ukraine war. And then you still have a few days left of the Olympics. That sometimes can turn into some kind of geopolitical thing, like it did back in 1972. All right, so some comments. Weaker than expected jobless claims help the markets think that recession, this idea that, oh no, we're going into a recession. Gee, do you think people overreacted to that? maybe these overreactions were a bit overblown at this point. At least that's what they were thinking on Thursday. Now, we're not going to have any economic reports on Friday, so there's really nothing to overreact to as far as that is concerned, but the market can still react to things anyway. Mega caps, growth stocks, and semiconductors, they had a good day, and these are the areas that have been underperforming lately. Well, not on Thursday, and that helped things go higher. Our list is quite a bit shorter now with the short-term oversold or extreme negative readings. We just have the CCI 20. All of the other indicators have dropped off. We saw enough of a bounce to get them out of being extreme negative. The force index is not really extreme, but it's still quite negative currently. And then the slope oscillator takes longer for the oscillators to move around a little bit. And then our intermediate term list is also quite a bit short now. The ease of movement, it did bounce up, as did the Chaikin money flow, but they're still giving us pretty extreme negative readings overall. And the scenario that the market's going with right now is that, okay, what's going to happen economically? Are we seeing a slowdown to the point of possibly going into a recession? Or are we seeing the point where the Fed could come in and cut rates to try to stimulate things and help promote more growth? And the market is still anticipating a rate cut in September. The dollar was up and interest rates were also up, even though this didn't pressure stocks. We're back up to 4% now with the 10-year yield, where we had been at 3.97%. We're still inverted with the yield curves. We got kind of close with the 10 to the 2-year, but it didn't quite go back to being regular, at least yet. And we're still extreme negative with sentiment. We ticked up from 20. We ended up getting up to 24, but that's still extreme. When we get these really low readings like this is when we consider using this as a contrarian indicator. And then as far as our trend, we are negative with the trend. The red line's on top, even though it's been coming down with the ADX. We're above the moving average, so that suggests a strengthening trend. With the up day, our bias is positive. I'm still keeping our momentum at negative for right now. If you look at the chart, and I'll show you lots of charts here in a moment, the context is still just not looking all that good. Now, it could always improve from here, but we just have to go with what we see right now. Okay, we just had the weekly continuing claims. They came in at 1.875 million, which was greater than what we saw last week with the continuing claims at 1.869 million. The first time jobless claims came in weaker than expected at 233,000. They expected 242. Last week was 250. They're blaming a lot of this stuff on Beryl, the big hurricane that came through. And especially like Texas had just massive initial claims because people weren't working while that whole hurricane was coming through. And wholesale inventories, and I don't have a chart of this one, it was up 0.2% as expected, but down from the 0.5% increase we saw last time. So here are the weekly claims. Now, even though they dropped off, we're still seeing the 4-week moving average continuing to go up. And continuing claims also holding fairly steady right now, but the moving average continues to advance. And here's just a chart that shows everything together. The initial claims are in red, then we have continuing claims in blue, and then the latest unemployment rate at 4.3% here, just to put everything on one chart. All right, looking here, the percent of 10 yield curves that are inverted, it's still pretty high right now. And when we get above this red dashed line, it just means that a recession is imminent. All right. Doesn't always mean it's really going to happen, but we're seeing a real cluster up here right now above this red dashed line currently. And then stocks tend to go higher even with bad news. This is just a historical chart going back to the 1900s. Of course, you probably remember the San Francisco earthquake. I think that was 1903, something like that. But these are just different events that have happened along the way and then how the market reacted to that. And Morgan Stanley's Global Risk Demand Index has recently fallen sharply into extreme fear. Now, this is how they measure things at Morgan Stanley, just suggesting that folks are very fearful at this point. When we get down to an extreme reading, this is often when we use it as a contrarian indicator. And then this is looking at the VIX and then the 3-month moving average of the VIX. and comparing it to the Fed funds rate, where we really spiked up on Monday, we're still very high with current readings right now. And then just comparing it to what it was along the way with the Fed funds rate. And then it's been the second longest manufacturing recession in history. This is just number of months without two straight blah, blah. Okay. Just we're seeing some economic slowdown. And this is what some folks are using to justify, okay, we just might end up heading into a recession. And cumulative flows into cryptocurrencies, even with the pullback that we've seen, it was like a 10% pullback. It's bouncing back now, but we're still seeing an awful lot of money really going into cryptos. And government spending year over year, it's actually fallen on a year over year basis. Of course, it's hard to top what was happening during the whole COVID lockdowns. And then the probability of a US recession in the next year, it's ticking up just a little bit. So some folks are saying, no, we're not going to go into a recession. Other folks are maintaining steady at about 30%, where some folks think it's 25%. So, and that's why I don't really debate these things or go back and forth or get real dogmatic with a stance about this, because these are folks that study these things all the time, and even they can't come up with what's actually going to happen. That's why we look at the charts. All right, strong performance follows episodic volatility. Okay, episodic volatility was what happened on Monday. Typically, what will happen after that is we'll see a really nice gain when those things happen. It's a little bit different right now. We're not seeing an awful lot of follow through from what we saw on Monday, the decline. Now, we did have a really good up day on Thursday, but it was on below average volume, so there's not an awful lot of conviction behind it, at least right now. Okay, didn't find anything interesting with the Yardeni's latest post. Interesting charts, but doesn't really apply so much to what we're analyzing here in these videos. This was kind of interesting. If you watch these videos regularly, I was kind of making fun of a guy. I guess it was Jeremy Siegel, who was on CNBC saying, oh, the Fed needs to make an emergency rate cut, 0.5% now and 1.5% in meeting, and just getting all crazy about it. Well, since that time, give him a couple of days and he backs off that call. So he's kind of changing his mind. Okay, here is our intraday chart, where we did have a nice little move up right from the open, and we were able to stay above the daily pivot. We got up to R1. This is where I was looking for, okay, are we going to try to pull back and fill some of this gap and possibly come down and test the unchanged level and possibly turn negative? We didn't do that. We were able to maintain these gains. There was a little choppiness going on here, but nothing really significant. And then finally, we were able to break out above the 5,300 level, tried to come back down to it, but then ended up bumping up right at the end of the day. In our intraday chart, not seeing things all that change going from Thursday into Friday session in the initial overnight session. We're still seeing where value, the red line, is on top of the blue line here on an intraday basis, and we saw a bit of an improvement here with the growth to value ratio intraday for the S&P. So looking here, growth was up over 3%. Value also had a pretty good day, but up about half as much. The mid caps also saw growth outperforming, as well as with the small caps. But when we look at our end of day charts, yeah, they're bouncing up, but they're not really showing any leadership right now. Here with the small caps, we ticked back up a bit with the mid caps after they had been declining, and ticking up, but not really breaking out or showing any leadership here with S&P growth to value. This is an area that we've been keeping an eye on with a growth ETF versus a value ETF and doing a ratio. We had fallen down below this 250-day moving average here. Now we're been able to get above this. So we'll have to see if we can see more improvement there. We're not seeing really any improvement here with discretionary to staples, the ratio down along the bottom, even though it ticked up a bit. Excuse me. We're still right in between the 200-day moving average and the 100-day moving average with the large caps. We're finally able to deal with that a little bit here when I get to the S&P charts, but we haven't quite done that with the large cap growth yet. And we saw a bit of a bounce up here, and then there was a bit of a decline in Thursday session, but we have been going back up when we look at large caps versus small caps. And when this is going up, that means the large caps are outperforming. Here's our trend. We're coming down with the red line, but the red line's still on top. So we default to positive. We're still above the moving average with the ADX. So that's a strengthening negative trend. And we're seeing pretty much that same thing. But now we're getting back up into this 40 area again with the ADX itself, even though the red line has been coming down. And we dropped off with volume, but still, it's been looking good lately. But to see an update on below average volume is a bit of a concern. All right, then still seeing where the ulcer index continues to go up here. We're coming down, but still at very high levels with the VIX on a closing basis, as well as the bar chart. And the VIX of the VIX, since we had the update, is also coming down with the bar chart as well as the line chart, but still really high readings. And seasonally, it's not necessarily abnormal to see the VIX really pick up like it's been doing. And the momentum, even though it's rolling over, is still up when measured with the MACD. And the VIX to move ratio, stocks to bonds volatility, has been coming down as stocks have been bouncing. And so we have the move index on top, which is falling down. We have the VIX, which is coming down too. And the correlation between the volatility of stocks and bonds still remains quite high. And this is interesting. We had a really solid update, the biggest since 2022 or whatever anyone was saying. And look at how the equity put call ratio really spiked up. So we continue to go up, and we're getting close to this extreme reading with our 5-day chart, and we continue to go up with the 10-day chart. And we're keeping an eye on this spread between risky and not as risky bonds. It's not as evident here, even though this has been spiking up. We want to keep an eye on this, even though it's inverted. This is the middle area. When this is going down, that means there's more risk between risky and not as risky bonds. Well, it did tick back down, but it's giving us much higher readings than what we've been seeing recently in 2024 anyway. And we came down a bit here with this fear gauge. We also came down with this other fear gauge. So we're seeing things start to settle down as far as sentiment, but still giving us quite high readings. And we ticked back up here with the risk on to risk off ratio, even though it had really been coming down. It showed a bit of a bounce on Thursday. And we had the latest reading of the American Association of Individual Investors. They're down around the midpoint now. Remember, this is a week old, and it had really dropped off. So we're more in neutral territory with this sentiment gauge. And the volatility risk premium is coming back down into this band. And we ticked back up with the advanced decline line based on price and volume, but we're still seeing this longer term negative divergence between price and volume, and didn't really see a breakout of the new highs to have a big update like we saw. Of course, we've been in this area not so long ago, and that might be why there's no real new highs that are being generated. Not really seeing an expansion of the new lows, but our 5-day and our 10-day moving average continue to fall. And we're back above zero with both the 19 and the 39 period advanced decline ratio. And we're coming back up, but we're still below a declining moving average with the accumulation distribution. So this is still negative, but showing some improvement. The boom indicator was able to bounce up enough so it's no longer extreme negative. And we ticked back up here with the Chaikin money flow, but not enough yet anyway to really turn this red line to go back up. It's flattening out, and we're still extreme negative. But we want to see this really start to go back up if we're going to turn more positive. And the Chaikin oscillator continues to go up and is not extreme negative, but it's still negative when you take it all together. So we saw a bit of a bounce here with the NYSE cumulative advanced decline line, and we've been holding up fairly well here with the NYSE advanced decline line. Even with Monday's big downward move, we never did dip below the moving average. And this other NYSE advanced decline line is still holding up quite well. When we look at the common stock on the NYSE, based on price for the advanced decline line, we did tick up. We also ticked up based on volume, but you notice we've been leading the way down more with volume. And because we had such a solid update, the advanced decline ratio from one day to the next probably suggests we overdid things a bit here. And we're still holding up when we compare the NYSE advanced decline line with the S&P. The red line is still above the bar chart here, even though they are on different scales. And we're holding up fairly well with the advanced decline line studies. We went back up with the NYSE common stock, the S&P, The mid caps are getting a little bit further above the moving average, and the small caps also turned up above their moving average. Here's our chart. Not anything really to show here as far as what's plotted on this particular chart. We're still underneath the 50-day moving average. On the bottom, we did drop to below average there. And we're no longer extreme with the Stochk RSI. The Williams percent R is bouncing up after being extreme. The CCI 14 is no longer extreme, but the CCI 20 is just still a little bit extreme negative. And in the short-term stochastic, saw enough of a bounce here to wear that off. We wore off the intermediate term, and we never did get extreme with the long term. So it's not very common to see this. Usually the stochastics are always on our chart, are on our list, because we have 3 different charts that make up this study. And we ticked up with the 20, 50, and 200 period moving averages for the S&P. We're still seeing a weakening trend. This is studying the 20 period moving average trend study here, and they continue to decline. And the force index still quite negative. It had come down and was hitting the Keltner band here. It bounced back up, but still, this is a lower reading than what we've seen over the past year. And when we go from Wednesday to Thursday with the rate of change, it looks like we probably overdid things. The 5-day is no longer extreme and starting to bounce up here. And we're coming back into the -1 channel, just barely, with our standard deviations chart. We had come all the way down into the -3. That's when we're extreme negative. -2 to -1 is more, I don't anyway, consider that to be really extreme negative. And we ticked up, but we're still negative with the balance of power. Looking at the condition of the 50-period moving average, we're continuing to decline here. The longer we stay below that, the more these lines are going to continue to decline themselves. We're still a no-go with the go, no-go system, and we're still bouncing off of the lowest low value here with this study. The TTM squeeze, seeing a little bit of an improvement here. After getting extreme negative, it's turning to a lighter shade of red. And here, you can't see the lighter shade of red here, but this gives a longer term look at these extreme positive and negative readings. And we're still moving around an awful lot with standard deviation. That just means we're moving quickly with speed, not necessarily direction. And the ease of movement did bounce up, but it's still giving us a really extreme negative reading. The Erin is pretty much flat and went to sleep. We bounced back up here with the S&P McClellan oscillator, but we're still below 0. So we continue to decline based on price, even though it could be flattening out here. And we continue to decline, but a little bit slower here based on volume. And then we look at the advanced decline line cumulative based on price for the S&P. It did tick back up. We were going down with more velocity with volume, but it also improved. And here's the NYSE McClellan oscillator, also bounced up, but still below 0. So the summation indexes based on price and volume continue to decline. And we're negative, even though we're showing a bit of improvement here with the Swenlin trading oscillator based on price and volume. We continue to decline with the PMO. We're dropping below the midpoint here. We're negative with price, and we had been negative for longer here based on volume. But we saw a bit of a bounce here with the PMOs that are rising. We were getting close to an extreme negative reading here. We're flattening out with the buy signals, and we're also flattening out with the PMOs that are above 0. And we've gone from being negative to neutral with the Elder's Impulse system for the S&P. The parabolic SAR is still negative. And we're trying to turn up a little bit here with the slope oscillator, but we're getting a real extreme reading. However, it's still negative. And the MACD really isn't turning all that much, at least yet. So this continues to be negative. So all of our oscillators, the short term trying to turn up a little bit, but we're still looking negative across the board with the intermediate and long-term oscillators. The Kopit curve trying to turn up. Could make a case that we're getting extreme negative here. It's the lowest reading that we've seen over the last year, but it's still negative nonetheless. And here's the 100 period moving average, just ticked a little bit above it. And this has been a real area of battle lately, which is also right around the 5,300 level for the S&P. And here's another look at how we're just a little bit above the 100 period moving averages. We tick back up, but still more neutral with the Sean trend meter. We're still negative with the bullish percent index for the S&P, negative with the NYSE bullish percent index, bouncing up a little bit, but still negative with the NASDAQ 100 bullish percent index, bouncing up but negative with the money flow, bouncing up but still negative with the ultimate oscillator. We're declining with the vortex. The red line is still on top. We're negative, but it is showing a decline with the red line. We're still below the moving average with on-balance volume. And we're showing an improvement here with those stocks above their 20-period moving averages, but they're still below 50. We did cross back above 50 with those stocks above their 50-day moving average, and a bounce up here with the 100-period moving average steady, and a bounce up with the 200-period moving average steady. And we're still waiting for this to stop going up and roll over and see if this is going to give us some kind of a signal with the mass index here. Showing some improvement, but still negative with the RSI 14 as well as the RSI 9. And we're just keeping an eye on these Fibonacci retracement levels in case we start to see more weakness. Coming back up into the cloud again here with the Ichimoku cloud, but we're still looking negative here. The blue line is still below the red line. Even though we're back up into the cloud, we did see a bit of a bounce here with the green line. And coming back up a little bit above this 23.6 fib extension here for the S&P. And this is longer term, what I'm also keeping an eye on. This is 51.10, 51.11, and we came down close to that. So far, we've been able to stay above it. And then looking at the trend, showing a little bit of improvement here with the Heiken Ashi with an open candle. Still negative, but pointing up with the Kegi chart. Still negative with the Renko chart, and we're negative with the 3-line break chart. And then longer term, the 150 and 200s are seeing some improvement and not extreme right now. And we're still negative in the short term with all the different indexes. We're negative in the short and intermediate term with the NASDAQ 100. Negative with stocks, positive across the board with bonds, negative across the board with commodities, and still negative in the short and intermediate term with the dollar. All right, and we saw an awful lot of blue with the up day where later on passed below 5,200. Is that right? Because we've been above 5,300 here, so that might be an erroneous signal there. All of the sectors ended up being positive with tech leading the way higher. And still showing where the red line is above the S&P 500. So the equal weight is still hanging in there pretty well. And we came back up a little bit here with our S&P to equal weight index as the mega caps had a pretty good day. We're still negative with this. The new highs minus the new lows, the daily score on the NYSE, we came back up, but we're still showing a minus 13. And we're coming right back up to the 50-day moving average with the Dow. We're switching from negative to neutral with the diamonds for the Elder's Impulse system. And not really much of a change here. Still above the 200-day moving average with the NASDAQ, still below this S1 level. And coming right up to this S1 level here. This could be acting as overhead resistance for the NASDAQ 100. We've gone from negative to neutral for the QQQs when looking at the Elder's Impulse system. We are bouncing up here with the NASDAQ 100, but the PPO continues to show that we're quite negative and possibly extreme negative, even though it's trying ever so slightly to turn up a bit now. We're still above the 200-day moving average with the Qs, but we've seen a recent cross here with the 20s crossing below the 50 with the moving averages. And coming back up into this zero area here with the fib extensions. And at some point, when the chart makes a little bit more sense, I'll redraw these and we'll come up with some new targets. The small caps, they were up 2.3% and actually climbing back above their 50-day moving average. And so we're turning back up with the Russell 2000 small caps. With the RSI, we're still below this 50-day moving average here. The momentum continues to be negative for the small caps. And we've gone from negative to neutral with the small caps when looking at the Elder's Impulse system, still below the 50-day moving average with the mid caps. And we've gone from negative to neutral with the mid caps with the Elder's Impulse system, still in between here with the Wilshire. So this has been holding up okay, but not, I mean, it was up 2.3%, but really we haven't gone anywhere over the last few sessions. And we're in between the 50 and 200-day moving averages here with our total U.S. stock ETF. And we did bounce off the FANG index. This was a 200-day moving average bounce up off of here, and we saw a nice move up 3.5%. But when you take all these bars together, it's like we're on a treadmill right now. And we still are going up, even though it pulled back slightly with our staples to tech ratio. We want this to go down to be positive. If it keeps going up, that will be more negative. And I haven't shown this chart in a few days. The financial sector was able to regain its 50-day moving average, and it's still in a longer-term uptrend. The dollar, it was up a bit here, and it's still in a longer-term uptrend, even though it's well off of these higher levels that we had been seeing. Apple was up 1.66%, coming back up to its 50-day moving average. We're still below the 200-day moving average with Amazon, bouncing up 1.94% with Google, above its 200-day moving average, coming back up to its 200-day moving average with Microsoft. Meta is breaking out a little bit above its 50-day moving average. Nvidia right in between both the 50 and the 200, even though it was up 6%. Tesla is still below both of the moving averages, even though we saw a recent golden cross here with the trend. Netflix also between its 50 and 200-day moving averages and was up over 3%. We look at the broad market of the 5-period moving average of the highs minus the lows, we're still negative here. And we're seeing a pretty strong correlation between US stocks and world stocks when we look at it based on 10 periods, and it's getting stronger here based on 50 periods. Keeping an eye on oil in case things really escalate in the Middle East, getting up more into the mid-range of the 70s now. And keeping an eye on the ratio between small caps and the tech sector. It had really been coming up as small caps were showing favor. But since the tech had a good day, this ratio has come back down slightly. And also keeping an eye on the Japanese yen. This real move up, this is what caused everything that happened on Monday. And now we've been coming down since then with the Japanese yen to the US dollar. And we're going back up now to 4% with the 10-year yield. And we've been coming down with the 10-year based on price. And our growth to value ratio is not, I mean, some of them are showing some improvement, but really no strength right now with the Qs to S&P, discretionary to S&P, large cap growth turning up a little bit when compared to large cap value. But all of these moving averages are declining. And so with the large caps, mid caps, and small caps, we are still below declining moving averages, ticking back up slightly, but overall we have been declining with the S&P to utilities ratio and have been going up, but we pulled back with the staples to S&P ratio. And we were able to get back above zero with the advanced decline line based on price. We're still below zero based on volume. So what's our outlook for Friday? We're still negative. And right now, it just looks like we were working off being oversold. Now, there's some positive signs that we could look at, but we also want to respect what we see happening too. We're still in a short to intermediate term negative trend. We're not going to have any economic reports, so maybe volume will be below average. Maybe it'll be kind of a quiet day. Who knows? Every time we think that's what's going to happen, things end up going crazy. And we want to keep an eye on all the different geopolitical things that are happening. And those could escalate and have an impact on the market at virtually any time. No economic reports on Friday, nothing to show here. Seasonally neutral to negative for August 9th, so not really an edge, if anything, more of a dip to the negative side, or at least a bit of a bias that way. But Friday is the second most positive day of the week, at least how things acted in 2023. Finally got this chart, where we'll be on the 7th trading day of the month, where we do see some negative seasonality. And this is the longer term look when the incumbent president is not running for re-election. We have some bumps along the way here, but we tend to perform fairly well in the bigger picture, where September tends to be negative based on this chart as well as this chart. But during an election year, that's when things tend to perform the best based on the Carson research. So what are our warning signs? Still keeping an eye on these defensive sectors like staples, utilities, and healthcare. Those are the big ones. We're watching energy in case something geopolitically happens in that area. The growth to value, discretionary to staples, they've ticked up a bit here, but they're really underperforming and not showing any leadership. We're still going up with the 5 and the 10-day equity put call charts. And we're still looking extreme with accumulation distribution, but we could be seeing a bit of a bounce here now. The chicken money flow is also extreme negative, and we're actually starting to advance here with the chicken oscillator. We're still negative, even though we showed some improvement with the S&P and NYSE McClellan oscillators, as well as summation indexes. The Swenlin trading oscillator is still negative, as is the bullish percent index for the S&P. The parabolic SAR, the ease of movement, is still giving us a really extreme negative reading. The money flow, the vortex, our oscillators, the ultimate oscillator, the Kopic curve, the bullish percent index, and we're still looking extreme with the momentum for the NASDAQ 100 as well as the bullish percent index. All right, then positive signs, still kind of a short list here. The advanced decline line is actually doing okay. And the financial sector was able to get back above its 50-day moving average. So our conclusion, we're still negative, and right now it just looks like we're working off being oversold. We haven't really switched back to a positive stance, at least yet. We're negative, but we're less oversold in the short and intermediate term, but we're still positive in the long term. Thank you. I hope you have a really good day, and I will talk to you in the next video.